Imagine being told that the secret to becoming rich is to avoid debt at all costs. Then imagine discovering that some of the wealthiest people and largest companies in the world borrow enormous amounts of money. They borrow to buy buildings, acquire businesses, build factories, develop technology, and purchase assets worth far more than the cash they personally invested. So who is right? Is debt the enemy of wealth? Or is debt actually one of the tools people use to become rich? The answer is uncomfortable because both ideas can be true. Debt can accelerate the creation of wealth, but it can also destroy years of work in a matter of months. The difference is not simply how much money you borrow, it is what you borrow for, how much the debt costs, what produces the money to repay it, and what happens when your plan goes wrong. Most people first encounter debt as consumers. They borrow to buy a phone, a television, a vacation, a car, or a lifestyle they cannot yet afford. The money arrives immediately, but the obligation remains for months or years. The purchase may create comfort or pleasure, but it normally does not create new income. The phone becomes older, the car loses value, the vacation ends, the monthly payment continues. This is the kind of debt that makes tomorrow's income pay for yesterday's consumption. And when interest is added, the borrower does not simply pay for the object. The borrower also pays for the privilege of receiving it early. This is why debt can quietly reduce a person's future freedom. A portion of every future paycheck has already been promised to someone else. Before the borrower can save, invest, or take a risk, the lender must be paid. But wealthy investors often use debt in a very different way. Instead of borrowing to consume, they borrow to acquire something capable of producing income or increasing in value. A landlord may use a mortgage to acquire a rental property. A business owner may borrow to purchase equipment that increases production. An entrepreneur may use financing to open a second location. A farmer may borrow to buy machinery that allows more land to be cultivated. In each case, the debt is connected to an asset or activity expected to generate money. That is the basic idea behind financial leverage. Leverage means using borrowed money to control an asset larger than the amount of cash you personally invested. Suppose an investor has $20,000. Without borrowing, that investor can purchase an asset worth $20,000. But with a loan, the same $20,000 might become the initial payment on an asset worth $100,000. The investor now controls a much larger asset. If the asset produces reliable income and rises in value, the investor can earn returns on the entire asset while having contributed only a fraction of its price. This is why leverage can appear so powerful. But leverage does not only magnify success, it also magnifies failure. Imagine that the $100,000 asset falls in value by 10%. The asset has lost $10,000. For the property itself, that is a 10% decline. But for the investor who originally contributed only $20,000, that $10,000 loss represents half of the investor's starting capital. A relatively small decline in the value of the asset can produce a devastating decline in personal wealth. And the loan does not disappear because the asset performed badly. The lender still expects to be paid. This reveals the most important rule of debt. Debt creates a fixed obligation in an uncertain world. Revenue is uncertain. Employment is uncertain. Markets are uncertain. Tenants can leave. Customers can disappear. Equipment can break. Interest rates can rise. A recession can begin. A medical emergency can interrupt a career, but the payment date remains fixed. That is why the real danger of debt is not always the interest rate, it is the loss of flexibility. A person with no monthly payment can survive a period of low income by reducing expenses. A heavily indebted person has much less room to adapt. The lender's claim arrives whether the month was profitable or disastrous. This is also why the popular distinction between good debt and bad debt is incomplete. People often call a mortgage, a business loan, or a student loan good debt. Credit cards, luxury cars, and consumer loans are often called bad debt. But the name of the loan does not determine whether it is good. The outcome does. A mortgage on an overpriced property with unaffordable payments can become destructive. A business loan used to finance an untested idea can ruin the owner. An expensive degree that does not improve a student's earning power may take decades to repay. Even debt used to buy an asset can be dangerous if the asset does not produce enough cash. The correct question is not, is this good debt? The correct question is, what will repay this debt? If the answer is only your salary, then your labor is carrying the entire risk. If the answer is rent, business profits, royalties, increased production, or another dependable source of cash flow, the asset may help carry the obligation. But even then, the numbers must work. Suppose an investment appears likely to produce a return of 10% while the loan costs 7%. At first, the difference looks profitable. But the calculation may ignore maintenance, taxes, insurance, vacancies, transaction fees, unexpected repairs, and periods when the asset produces no income. A small theoretical profit can disappear quickly. Successful borrowers therefore focus on the margin of safety. They do not ask whether the project can repay the loan when everything goes perfectly. They ask whether it can continue repaying the loan when sales fall, costs rise, or income stops temporarily. This is one of the greatest differences between professional investors and inexperienced borrowers. The inexperienced borrower studies the best possible outcome. The experienced borrower studies the possibility of survival. Before accepting debt, that borrower may ask several uncomfortable questions. Could I still make the payments if revenue fell by 30%? How long could I survive without a tenant or customer? Is the interest rate fixed, or can it suddenly increase? Am I personally guaranteeing the loan? Could I lose my home, savings, or essential equipment? Can I sell the asset quickly if the plan fails? And after paying every expense, does the investment still generate enough cash to justify the risk? These questions do not eliminate danger. They make the danger visible. Debt becomes especially risky when it is used to speculate. Borrowing money to purchase stocks, cryptocurrency, or another volatile asset can create rapid gains when prices rise. But when prices fall, the investor can lose not only personal savings, but also money that must still be repaid. In margin investing, a broker may require the investor to deposit additional funds when the value of the account falls. If the investor cannot provide the money, assets may be sold at the worst possible moment. The borrower loses control precisely when control is needed most. This is why debt should never be confused with free capital. Borrowed money is rented money. Interest is the rent. Collateral is the lender's protection. And the repayment schedule is the clock constantly running in the background. So, must a person borrow to become wealthy? No. Many people build wealth gradually through income, disciplined saving, business ownership, and long-term investing without using large amounts of debt. Avoiding debt can create resilience. It can reduce stress, protect cash flow, and give a person the freedom to reject bad jobs, survive emergencies, or wait patiently for better opportunities. But refusing all debt can also create limitations. A person may spend many years saving the full price of an asset while its cost continues to rise. A profitable business opportunity may disappear before enough cash is accumulated. A company may remain small because it cannot purchase the equipment needed to expand. Debt can compress time. It allows a borrower to use future income today. That can be extremely valuable when the opportunity is strong and the repayment plan is realistic. But compressing time also compresses risk. The borrower receives the potential benefit immediately and accepts years of obligation in return. The goal, therefore, is not to become completely fearless about debt, and it is not to become completely terrified of it. The goal is to make debt serve a productive system. A productive debt normally has several characteristics. It purchases or strengthens an asset capable of generating income. Its cost is lower than the realistic return expected from the investment. The payments remain manageable even under difficult conditions. The borrower maintains emergency reserves instead of investing every available dollar. The debt has a clear purpose, a clear repayment strategy, and, ideally, a clear exit plan. Most importantly, failure does not destroy the borrower's entire life. If one bad investment can erase the home, retirement savings, business, and family security at the same time, the potential reward may not justify the concentration of risk. Real wealth is not simply owning expensive assets. It is controlling assets after subtracting everything owed to other people. A person may control 10 properties and still have very little true wealth if the banks effectively own most of their value. Another person may own one modest home, a profitable small business, and a diversified investment account with little debt, and possess a far stronger financial position. Appearances can be misleading. Debt can make someone look rich long before that person becomes wealthy. The luxury car, large house, and expensive lifestyle may not represent ownership. They may represent monthly obligations. True wealth is revealed not by what a person controls, but by what remains after every liability is counted. So, should you go into debt to become rich? Only when the debt is buying something more productive than the debt itself. Only when the expected return is based on evidence rather than excitement. Only when you can survive the investment performing worse than expected. And only when the loss will not destroy the foundation of your financial life. Debt is not wealth. Debt is an amplifier. In the hands of a disciplined borrower, it can amplify knowledge, productive assets, and profitable opportunities. In the hands of an impatient borrower, it amplifies optimism, mistakes, and losses. The same tool that helps one person build a business can force another into bankruptcy. The same mortgage that allows one family to acquire a valuable home can trap another family in payments it can no longer afford. The same borrowed dollar can create income or consume it. The final answer is therefore not that rich people use debt while poor people avoid it. The deeper truth is that skilled borrowers understand exactly who will repay the debt. If the answer is a productive asset, supported by realistic numbers and protected by a margin of safety, debt may become a bridge toward wealth. But if the answer is hope, speculation, or a future salary that has already been stretched too far, debt is not building a bridge. It is digging a hole. You do not become wealthy because someone agrees to lend you money. You become wealthy when the money you control creates more value than the money you owe. And until that happens, the debt is not working for you. You are working for the debt.